Okay, so let's assume we have a company. We'll put our company over here. It has what? A business of some kind, let's say a factory. We'll draw ourselves a little factory, making stuff. It has some trucks. Hold on, truck, here we go. What else does it have? It has workers, right? People who are working here. All right, what else? Some intangibles like contracts or intellectual property. But most importantly, it generates profits. It makes money. It's a business, right? And the business is owned by a group, and we'll call them generally sellers for our purposes. And sellers have decided that they're ready to sell the business to a group we'll call, for the moment, buyers. Okay. And so what we have is an acquisition where buyers are sending purchase price to sellers in exchange for their business, right? Now, absent some wrinkle, this acquisition would be just simply called an acquisition. And so what makes an acquisition a leveraged buyout is where does the purchase price come from? Now, and we add a new set of players in the leveraged buyout context called lenders. And what lenders do is they contribute to the purchase price what we'll call debt financing, right? And so in other words, they're going to lend somebody, in this case buyer or an entity set up by buyer, a certain amount of money, the proceeds of which they're going to use, buyer will use, to pay sellers the purchase price, thereby reducing the amount of money that buyers have to come up with to pay the purchase price to a smaller amount. And we'll call that smaller amount the equity financing. Okay? So a leveraged buyout is an acquisition of a company where part of the proceeds used to come up with the purchase price to buy the business is borrowed as debt financing from a group of lenders. So then what is a management buyout? Well, the wrinkle of a management buyout is that we have to think about another group, this group, and that's the management team, right? So usually the officers of the business that the seller is selling or sellers are selling. And what makes a buyout a management buyout is when this group, the officers of the business, some portion of them, it doesn't need to be all of them, are participating with the buyers in buying their own business, right? So a management buyout is when a private equity buyer partners with management in order to do a leveraged financing of an acquisition of the management's company. That's a management buyout, or MBO. So as we mentioned already, an acquisition is when we have one group, and we'll call them generally the buyer, is acquiring from another group, and we'll call it generally the seller or sellers, a business, right? Now, to be a little bit more precise though, the parties to an acquisition generally are the sellers, who are the owners of an entity of some kind, right? Corporation, limited liability company. And it's that entity which owns all of the assets and operations that make up the company that's being bought, the target, right? We'll call that entity the target. Okay, so sellers are the owners of target, and target, which holds the business that's being acquired, is the entity that's being transferred to buyer. And buyer consists of actually more than one group. Usually buyer consists of the investors And that can be the private equity firm. It can be management of the target if we're doing an MBO. It can be others, for example, the providers of debt financing. But they, in turn, invest in and are owners of an entity. And the entity is usually a corporation or a limited liability company. And that entity is technically often referred to as the buyer, or often also called NewCo. And why would we call it NewCo? Well, usually these entities are newly formed corporations or limited liability companies, meaning that they are formed specifically for the purpose of effecting the acquisition. And that's what we mean by an SPV. SPV is short for Special Purpose Vehicle. In a leveraged buyout, normally we don't have an entity that's pre-existed. So it's not like Apple is buying some other computer company. But instead, what is going on is a group of investors have gotten together and are forming a new entity from scratch. Didn't exist the day before. They file a charter or a certificate of formation in Delaware usually, and create this brand new entity called buyer or NewCo that for the special purpose of acquiring a target in this acquisition. All right, well, we already mentioned that buyer over here, the entity that's going to acquire the business in the acquisition, which we've also referred to as NewCo, is actually owned by a group of investors, right? And who are these investors? Well, the primary investor is the private equity fund, right? And a private equity fund, let's put this one over here, PE fund, is the entity that is the primary source for providing equity financing to NewCo, right? So it provides the capital that then in turn is enhanced by the borrowing from the lenders, which in turn is used to pay the purchase price. And this private equity fund is generally speaking a limited partnership, which is also sometimes referred to as the sponsor, right? So the private equity fund or the private equity sponsor is the source of equity financing to buyer. So it's the equity investor that provides the equity financing needed to do the acquisition. Now, since it's a limited partnership, we know from our study of business organizations that the limited partnership needs a general partner, right? And then also has limited partners, okay? Now, the bulk of the capital available in the private equity fund to provide equity financing comes from the limited partners. The limited partners tend to be either wealthy families, wealthy individuals, university endowments, insurance companies, pension plans, etc. These are large institutional investors that are interested in finding ways to invest their capital in a different asset class. And in particular, they're interested in investing in leveraged buyouts, right? And so they contribute capital into the fund, which then in turn gets used to fund these equity financings. The general partner, on the other hand, tends not to provide a significant amount of capital to the private equity fund, but rather is the manager or the investment professional, right, the portfolio manager that oversees the sourcing of the transactions and then the investment decision of whether or not to provide financing for a transaction in the leveraged buyout, right? And so these are the folks, the GPs, as we call them, that we all hear about when we talk about private equity firms, right? So like KKR, Kohlberg, Kravis, and Roberts are the people who populate the so-called general partner. They're the decision makers, the investment professionals who affect investments by private equity funds. Now, why would someone want to be a general partner in a private equity fund? We know what limited partners are looking for. They're looking for returns on the investment capital that they put into the fund. Since the GP doesn't put capital generally into the fund, how does it get rewarded for its participation? Well, that's here, right? GPs usually have a typical deal with their LPs where they're being paid management fees and what we call carried interest or a promote, all right? And the most common structure for these management fees and carried interest are what is colloquially known as the 2 and 20 deal, right? Namely a 2% management fee, which is paid periodically, and then a 20% profits interest in the performance of the fund. And what does that mean? Well, let's just assume for a moment that we have a fund with $1 billion of committed capital, much like the fund we're looking at, BGI Overseas Fund is a $1 billion fund. What does that mean in terms of the management fee that is being paid by the fund and therefore by the limited partners primarily to the GP? Well, 2% of $1 billion is $20 million. And so this fund every year will pay to BGI as the GP a $20 million management fee for its services in managing the fund, in sourcing deals, and in supervising the investments that the fund makes in these equity financings. But so that you'd think that that's, is that all they're going to make? Well, the answer is no. Assume for a moment that these investments that the fund makes are successful in the end, and that $3 billion of proceeds or realizations come back, right? So they invested $1 billion of capital, but they get $3 billion back when they ultimately sell their investments, their equity financings. Well, what it means to have a 20% carried interest is that $2 billion of profit is shared between the GP and the LP as follows. 20% of it, or $400 million, goes to the GP. That's their carry. And the remainder, the $1.6 billion of the $2 billion of total profit, is then distributed to the limited partners, right? So not a bad living if you can get it. 2 and 20 is often viewed as a very lucrative proposition for GPs, assuming they're successful in investing their funds well, because they get, for having put very little capital at work themselves, a very significant percentage of the upside of the investments. So that's how private equity funds work and who they are in the structure of providing the equity financing to NewCo. So as we've already discussed, Buyer is a new company. It's newly formed, right? So newly formed companies tend to be have nothing in them. And so how is it that Buyer is going to have the money available to buy the target from the sellers, right? And the answer, of course, is investors, including the private equity firm, as we already saw, are going to invest money into Buyer. And in this case, investors are going to first invest what we call equity, right? And equity takes the form typically of common or preferred stock or units, depending on if it's a corporation or a limited liability company. And the thing about equity that is unique is that it has good parts and bad parts, or more risky parts, I should say. The good part is whoever owns the equity owns the upside, the potential profits, the residual return that's available to the company they're investing in. And so the sky's the limit, theoretically, on how much they can earn, what kind of return they can get for their investment. Right? On the other hand, they are also what we call the first loss money. So if buyer is to not do well, if its value declines, the first dollar of decline comes out of the equity investors before it then affects the claims of senior investors. And who are those senior investors? Well, in the case of a leveraged buyout, we already saw that the trick is equity investors are combining their money with lenders' borrowings or lendings. And in this case, they're putting in more money needed to fund the purchase price, but their investment comes in the form of debt. And the difference between debt and equity is that debt has a fixed claim against the value of the buyer, meaning if you borrow $1,000 from a lender as debt, you must pay that $1,000 back at some point, right? You owe that full amount. If you can't pay the full amount, well, then lender has the right to foreclose that loan against you, whereas equity investors typically do not have fixed claims. They have residual claims. They have the right to what's left over, whatever that turns out to be. But in exchange for having a fixed claim, lenders also tend to have fixed upside. And so someone who loans money tends to have a fixed rate of return, a fixed reward in the form of a stipulated interest rate, right, as their upside associated with their investment. Now, why would someone be willing to take a fixed upside versus an unlimited upside that equity gets? Well, the answer is because of your position as a claimant in the capital structure of buyer. You tend to be, if you're a lender, a senior claimant, meaning if there were ever a point where buyer would be in liquidation, or there's ever an issue about who gets paid first out of the proceeds of buyer's assets, well, senior claimants get paid first. And debt ranks senior, so maybe I should have reversed their order here to equity, right? They get paid first. So just as debt ranks higher to equity in the capital structure, we can also have within debt different tiers of debt, different rankings among the debt holders as between themselves. Right? And in a leveraged buyout, it is very common for there to be at least two levels of debt. The senior-most level being the senior bank debt, and then another level that ranks below the senior bank debt called the subordinated debt. Right? We'll talk about that in a second. But senior bank debt is the highest ranking debt, which means that it has the first claim on the assets of the business in the event of bankruptcy or some other liquidation event. They get paid back first. It is very typical for senior bank debt to be secured debt. And what does that mean? That means that the holders of this debt take security interests in the underlying assets of the business, so that if in the event they are not paid back as promised under the loan agreement, they have the ability to go in and foreclose, much like a mortgage holder has the ability to foreclose if you don't pay your mortgage on your house, right? And so part of the reason why senior bank debt is the most senior is because it also wants to be the least risky. It wants to be the most assured that it's going to be paid back, because senior bank debt also tends to have the least reward associated with it. You know, the adage, more risk, more reward. Well, bank debt tends to be the kind of debt where it takes the least amount of risk in the capital structure in exchange for taking only requiring a fairly low rate of interest. Senior bank debt often comes in two flavors. These are both forms of senior bank debt. They're just structured a little differently, and so you ought to be aware of what these terms mean. A term loan is exactly what the phrase seems to indicate. It's a loan for a term, meaning it is lent at the beginning of the term and then is slowly paid back over time, but can't be reborrowed. So if we had a 5-year term loan, you'd expect it to have 5 annual repayments of, it could be anything, but not a surprising system is to have it be in equal amounts. So every year, or probably every quarter, adding up to a year, you'd pay back 1/5 of the loan over the course of the life of the loan. And once you've paid it back, you can't go back up, right? And so in a leveraged buyout, term loans tend to be loans that are used to fund the purchase price. The idea being that the business should then over time pay back the amount that was borrowed to buy itself, and that should not be allowed to use that money again for other purposes since it's already spent it on the purchase price. And that's different from a revolving credit loan, where basically the idea is you can recycle your borrowing. And those kinds of loans tend to be used not for things like purchase price, but rather for things like working capital financing, right? So if you have a business that has to build inventory over the course of a season, so like in the retail business, and then it is expected to sell that inventory at the end of the season, turn the inventory into cash, it would then take that cash and repay the revolving credit agreement, right? And hopefully generate enough profit out of that transaction, the buildup of inventory, sale, and repayment, that it also can fund the term loan repayments, all right? But those are the basic ideas behind senior bank debt. We have two kinds, basically, term loans and revolving credit loans. These cannot be reborrowed, get paid back over time. These can be borrowed, paid back, and reborrowed. Senior bank debt is the most senior ranking debt, therefore it gets paid first. It is often secured, supported by collateral. It is also, therefore, usually the one with the lowest interest rate. Okay. The other kind of debt in the capital structure, the one that ranks below senior debt, is called subordinated debt. So subordinated debt tends to sit in between equity and bank debt. Here we go, sub-debt, meaning that it has features that make it like equity. For example, it tends to have a much higher rate of return than senior debt. On the other hand, it has features that are also like bank debt in that it has fixed claims and it ranks senior to equity in terms of repayment. Okay. As we'll see, there are strong differences between sub-debt and senior debt. Sub-debt also includes different kinds of formats. So you can have subordinated notes that tend to be the format used when you have private investors. You have high-yield bonds when sub-debt takes the form of a publicly sold or resold security. But in any event, the important part for us is to realize that sub-debt is the layer of debt, also sometimes called mezzanine debt, because it sits in the mezzanine between the lobby and the next floor, is the debt that ranks senior to equity but junior to senior debt, but is still debt. Leveraged buyouts are a form of acquisition where a target company is being bought from its current owners, the sellers, by a newco or a buyer that is sponsored by a private equity sponsor and other investors, but then most importantly, with the assistance of debt financing. All right, that's where the concept of leverage finds its way into the deal, right? Because now it's not just the money from a equity provider, it's not just balance sheet cash from some strategic investor, but instead we have a newco that is funded by equity from a private equity sponsor and perhaps other investors, including maybe management, but most importantly is using borrowed funds to partially fund the purchase price that's being paid to the sellers. Now, leverage buyouts are not a special form of acquisition. They are a special category of deal because of the use of leverage, and we'll see why that makes such a big difference, both from a financial point of view, but also from a legal structuring point of view. But the form of, from a legal standpoint, the form of the acquisition is still going to be the same form that would otherwise be used if the purchase price were entirely funded through cash. Right? We are still going to find ourselves doing either a stock purchase, an asset purchase, or a merger. Right? The corporate mechanics of an acquisition are the same whether or not the purchase price is all cash, funded completely by equity, or partially funded through borrowing from a bank. Right? And so we should not confuse the concept of a leverage buyout or a management buyout as a specific separate form of acquisition transaction. It's just simply descriptive of a different kind of financing source. Okay? And so we should remind ourselves then what it is we mean by stock purchase, asset purchase, and merger, and why those concepts are important, not only to leverage buyouts, but to mergers and acquisitions in general. Right? So what is a stock purchase versus an asset purchase? Well, the best way to look at it is to think about our target, right? And our sellers, who are the owners of Target, either shareholders or limited liability company members. But remember, Target has in it, right? I remember drawing my little factory, right? And the contracts and the trucks, right? The assets of the business and the operations of the business are inside of an entity called Target, which in turn is owned by sellers. And the question is, how mechanically do you get that business into buyer, right? Which is our new entity. Right? How do we transfer that? Well, one way we could do that is by simply taking all of the things that make up the business, so the contracts, the cash, the people, the cars, the trucks, the real estate, and selling it to our newco, right? And that would work, right? That's what we call an asset purchase, right? And in exchange, we'd have them get money, the purchase price, and that works. The only thing, though, and the thing that is the reason why it's actually fairly uncommon for leverage buyouts or any form of acquisition to be effected through a asset purchase as opposed to some other form of deal, so meaning a stock or merger, is because of what? Well, asset purchases are fairly cumbersome. And the reason for that is because now, in order to transfer the business from target to buyer, you have to literally convey every single asset that makes up target to buyer. So you'd have to do essentially a real estate closing, a motor vehicle transfer, an assignment of contracts. So you can imagine What do you need in order to sign a contract? Well, generally you need the approval of the counterparty to that contract. And let's say you have a business that has thousands of contracts, you'd have to literally go around the table getting consents from all of the other counterparties to those contracts, right, and so on. You'd have to do hundreds and hundreds of filings for all the motor vehicles. You'd have to go around the country transferring pieces of real estate, et cetera, if this is a large, complicated business, right? Now, if it's not, if it's a small business and it has very few assets, well, then maybe that's more achievable. Because one of the attractive parts of asset purchases is it allows you to pick and choose. You don't have to buy all the assets, so if there are things you don't want to transfer or things you don't want to acquire, and more importantly, perhaps you don't have to take on all the liabilities that are associated with that business in an asset purchase. So you can be much more selective, right? But the problem is, again, as I said, it's harder, and so it's much more complicated to get that deal done. And so often buyers and sellers will choose not to do a asset deal, and instead we'll look at something else. Okay, so the other choice was, of course, as we said, a stock purchase. Well, how would that work? Well, let's again look at our situation. We have sellers, and they own Target, right? And then we have buyer, or NewCo, which is in turn owned by our investors, right? And what we could do is simply have NewCo pay the sellers the purchase price in exchange for the equity interest that seller have in Target, right? So for these, right? So the stock or the member interests, right? And if what we did is that exchange, money for shares, what we would have at the end, once the money was over, we'd have now NewCo owning Target as a wholly owned subsidiary, and buyers and sellers would in turn have cash, right? And that's a very clean transaction, right? Very easy. Now, as we mentioned, one of the things you can't do is thereby pick and choose what liabilities come along, because since you are now buying the entire entity, you're getting everything with it, including whatever liabilities are in that entity. But of course, you can address that through your reps and warranties and indemnification. So I think in truth, most people assume that you're going to have to contractually deal with what liabilities are coming across. So this is a much simpler way of getting this same result that we looked at in an asset deal done simply by transferring some pieces of paper. Now, why might that not be a viable alternative? And the answer is, well, it assumes that sellers are pretty easy to find and that their ownership in their stock or LLC interests is pretty easy also to find. And that would not be the case in what kind of situation? Well, primarily if sellers are the public, right? If what we're dealing with is a large group of dispersed sellers, namely public investors, public shareholders, it would be all but impossible to assume that you have the ability to go to every single seller and say, sell me your shares. You couldn't find them, let alone get them to come and sit across the table from you and transfer their shares over. And so the problem with acquiring a public company through a stock purchase is because it's just simply too hard to gather together all the sellers and collect up all their shares in order to get that transfer done. And so we need our third alternative. And the third alternative is a merger. And what a merger is effectively a stock purchase, but done by operation of law. And the benefit of a merger is that the statute provides us a solution to the collective action problem of collecting stock from a disparate group of sellers. And the way it does that is it says, if you have a buyer, you can have the buyer enter into an agreement with the target, right? And in that agreement specify that the shares of target will get turned into cash, and that the shares of buyer upon completion of the merger get turned into the shares of target, i.e. now suddenly this thing will transform into target, and target will end up being a subsidiary of investors, right? And how does that magic work? Well, it works because there's a statute under the state law, and usually Delaware law is the relevant law because our entities are Delaware entities, that says that if you get the requisite approval to this agreement, upon the effectiveness of the merger, this will deem to have happened, namely that these shares will have been turned into cash, and these shares will have been turned into shares of the surviving corporation, which we'll assume is Target, and therefore Target becomes the holding of the former shareholders of Buyer, which happen to be the investors, right? And so suddenly Target becomes a wholly owned subsidiary of investors, and sellers end up owning cash, right? And therefore, all the things that were in Target move into the entity that's now a subsidiary of investors, and sellers end up with money. I use the word requisite approval. Well, how is this better than going face-to-face, one by one, getting seller to sell shares? And the answer is, in most states, the requisite approval is board approval, okay? And then majority shareholder approval. So no longer do you need to get everybody to agree to sell. All you need to do is get one share over 50%. And then suddenly the other 49%, whether they want to or not, are suddenly going to see their shares turned into cash, right? And there are protections for those unwitting shareholders, but that's another discussion. The real point is, this is a statutorily, legally provided solution to the collective action problem that we saw in trying to do a stock agreement, stock purchase agreement with large dispersed shareholder groups. Now, those are all the forms of an acquisition. Those are the same forms that we could see being used in a leverage buyout. Again, the only significance of it being an LBO is that in each case, whether we're paying for merger consideration or consideration for the purchase of assets or consideration for the purchase of shares, no matter how we're structuring the deal, we are borrowing a portion of that consideration from a group of banks and usually subordinated debt investors.